Hey everybody, it's Tom, and we are coming to you this week with the inimitable Andrew Kassen, possibly Kassen. Americans, we flatten the A, but he's of German-American descent. I don't want to say German, that would be imprecise. And we may eventually come around to identitarian politics and how they've wrought havoc in Andrew's life and elsewhere. But in fact, what we really want to talk about today is the relationship between the terms of the market and narrative formation. And I'm going to add to that the consideration that within the American domain, I think there's a presumption, an operative presumption, that economics have a sort of autonomy from the political, and that presumption inflects the discourse in various ways. Probably the most obvious way is that you often encounter the trope that there is an ineluctable antagonism between the state and market operation, which I think is highly problematic, and we can come around and maybe interrogate that at a later point, but I'm going to rein myself in here for a second and turn it over to Andrew, and ask, at least what are these initial, the way you raised it earlier is that if we start by considering what price is, that can lead us into an awareness of how narratives really inform market operation. And so maybe you just want to make some introductory remarks from there.
Sure. So stepping back for a moment from markets to a conversation we were also having earlier, really around the nature of, and not to open this can of worms too much, but around the nature of consciousness. And so one idea is maybe a narrative or kind of a narratological conception of what consciousness is. So specifically thinking about how human beings apprehend both themselves and the world around them, and all of that. So one way in which we do that, or we tend to do that naturally, and it may be a function of language or not. I'm sure Tom has plenty to offer on that. But is the idea that we're kind of a homo neuratus, which is to say, man is a inherently narrative creature, and I think this goes beyond the idea of storytelling as we see it commonly. We were quipping a little bit earlier about this idea that humans are natural storytellers, and that seems to be kind of prima facie the case.
Well, in fact, I have a kind of a resistance to this thesis, and what I had noted to Andrew is that in part that resistance might be a function of how you can listen NPR or whatnot, and you get these accounts of how, well, if we could just tell each other the better stories, and we could all get along, and on one hand, I don't think that is really honest to what you're presenting, because you're looking at it, I think, at a deeper level than you're necessarily going to find there. However, in virtue of that, it circulates within the popular conversation. I admit that this translates into, it activates a prejudice in my person, because I concede that when things become popular, I am more inclined to see them skeptically, which is ironically juxtaposed with my commitment to a sort of a radical democratic ideal. But that's a whole other tangent, right? But to bring it back to narrative and identity formation, because I was thinking about that earlier. What strikes me is that there is something more fundamental to our being than narrative. And I think maybe that intuition on my part arises from the fact that whenever a narrative is posited, you have already so much sort of presumed in order for the structure of the narrative to arise, such as identity itself. Now, you might say that in fact the relationship between identity and narrative is sort of dialectical. It's hard to say, which comes first, the chicken or the egg. What then is identity? Well, then you ask the question, what is identity? It's actually hard to come at a response to that question without invoking relational terminology. You're already in a social context as soon as you talk about identity. And I'm like, well, what are we? And this is where someone might say, all right, now you're just being an academic. But I don't think so. But what are we apart from identity? If identity is necessarily the function of, being situated within a particular social context or operating functionally in some narrative, what are we before or apart from all that? If we're anything at all. And if I was to say, well, why is that an important question? And by the way, I was also talking with my friend Nick Bascom about this, and that was also helpful. I just want to give him credit. He helped flesh out some of these thoughts. I think it's important because of the term of freedom and the relationship between freedom and convention. And if we start to become a sort of essentialist as to, what we are, as participating in like a tribe or some social milieu or playing a particular role in a story, then our perception of action might become unduly rigid or ossified, and we might be sort of cut off from who and what we are most authentically. So much by way of my thoughts on this issue of identity and narrative and how it connects to the question of identity, and how the question of identity connects to human being. And this all seems, but so how? Let me turn it back over to you there.
Well, maybe, and admittedly, I'm still fleshing a lot of this out myself and wrestling with it and working through it, because it's the concept of narrative is kind of it's a syncretic idea, or at least the project that I'm pursuing, and I think the scope of it, and one of the reasons that I've been struggling with what I'm working on, is that it's pulling from so many different directions. We have drawing on a lot from philosophy of mind, and then there's a lot from behavioral economics, and notice I didn't say anything about neoclassical economics, although that of course informs the discussion as well. But maybe taking a step back and contemplating, the role of narrative, I think in identity formation is worthwhile, because as we as we think about, even just in a non-academic context, I have 3 small children, and I'm not going B.F. Skinner on them, but I do observe them, and just taking a look at how they begin to kind of perceive and apprehend the world around them, and just the raw responses that they register about their place in the world, and understanding their role in a family, etc. But maybe the idea of narrative as the kind of an organizational principle of much of conscious life. I think you'll find, and I would challenge anyone to do this. It's very interesting. You'll find as you go along, kind of what we'll call first order thinking, which is really just almost dispositional, thoughtless thinking. Just kind of the natural flow of our consciousness isn't really informed by, or isn't really structured as a narrative. But once we begin to, once we get into a current thought, where we're thinking intentionally, unless we have an external focal point, such as the topic of existentialism, or even this book, or we're focusing intently and purposefully on objects that are external to us, much of the activity of conscious thought, and by conscious I mean kind of almost purposeful, deliberate thought, right? A current thought is kind of is the phraseology that I've been using. It is often, or perhaps, I hesitate to say always, there's no way to verify that really, but often, at least for myself, and seemingly for many others, is framed in the language of, or not so much the language of, but the structure of narrative. So from there, it's looking at an examination of, the sweep of a narrative and how a narrative is structured in its classical understanding. So take a Greek tragedy or drama, or even a comedy, looking at characterization and then the arc of a narrative itself. And oftentimes we're delineating and discriminating between ideas and objects and individuals and a linear sequence of events in the language of narrative. So you raised an interesting point earlier about whether or not, again, getting kind of into the chicken or egg conundrum, whether or not, as we develop, we grow into, we hear stories. Story is a very primitive kind of, primal, and I would say kind of proto-developmental function that we develop as human beings. Children respond to story very early on. So there's something there that might, act on, a young impressionable human being to cause them to just begin to frame, everything that they're perceiving.
Hey everybody, we're back. This is the first time really shooting this properly, so there's a hiccup on the interval. The camera stopped, so sorry about that cutout, but let's just get right back to it. Andrew was just sort of rounding up the notion that if you look at how quickly story comes to life with children, it's sort of a clue that the narrative structure is something close to fundamental in how consciousness operates for human beings. And then you were about to move on from there.
Right. So working off of that basis, looking at consciousness, or as narrative, we'll say just kind of as a function, a basic function of consciousness. We can just use that as kind of a working concept and moving on from there. I think there's a lot in there to challenge and a lot in there to unpack. Certainly conscious of that. But in terms of the bigger picture of how this relates to markets, and how it ramifies for financial markets in particular, which is more to the point of what I'm focusing on, is that conceiving of narrative as kind of basically like a meta heuristic, or kind of the heuristic of all heuristics. This becomes important because you have a lot of work that's been done in behavioral economics on the role of cognitive bias in decision making. And this is another one of those TED Talk ideas that might test your patience or something like that.
Right.
I certainly know it's kind of de rigueur to go on and on about how kind of like terminally foibled our minds are, and how we're almost incapable of making sound decisions because at every turn we're about to run afoul of some bias that we weren't aware was going to be our undoing until after the fact. And
well, certainly being, as I sometimes put it, I'm an epistemological optimist, which is countercultural, because I'm like, well, until you have some reason not to believe it, you might as well believe it. But I wanted to come back, a few sentences. You could say, well, it's the heuristic of all heuristics. We should perhaps clarify, because what is it we mean by a heuristic? And then right in the wake of that, you bring up behavioral economics. But behavioral economics itself is already sort of a lens, which has presuppositions themselves. And maybe this is what you mean when narrative is the heuristic of all heuristics, right? Behavioral economics is already trying to fit phenomena into frame which permits it to tell a particular story about what we are as human beings.
Sure. So stepping back before that, talking about the heuristic of all heuristics, is that narrative is, and there might be an evolutionary explanation for this, perhaps. I don't think there's been a lot of work, if any, really, that's been done on this point. I'm probably not the person to do it, but it's an interesting topic nonetheless. So the idea that narrative, and following up from kind of the developmental perspective, is that narrative is a kind of shorthand for the organization of and in the apprehension of complex events, and it's a means by which we're able to kind of modularize and compress just kind of the raw data that we take in regarding a given event X into something that's more of a manageable format. So it makes us capable, or it's a means by which we're capable of more easily and readily and efficiently understanding, again, any given kind of event that we might encounter. And so it's perhaps in one part it's a coping mechanism, but it's also, again, a shorthand or a means of taking something that's overwhelmingly complex and breaking it down or consolidating it to a degree that it becomes manageable.
The only thing is I would almost, this might be funny since
you're funny,
resistant to the approach here, but I would almost say we shouldn't be so apologetic. Like, we shouldn't try and sort of justify narrative as something that's like, oh well, it emerges from evolution, or it's a coping mechanism, or what have you. Maybe there's actually something about the structure of reality that drives the importance of narrative, and what leads me to what might be something of a provocative assertion that narrative is actually connected with the structure of reality itself, is that it seems inextricably linked with the notion of time or temporality. So it seems that as far as we are temporal beings, our very temporality may be what compels us to assume or deploy narrative. What do you think about that?
I would agree. Yeah, and that's more. I would agree. That's maybe, well, admittedly more ambitious than what I'm offering up, but I have a tendency to err on the side of the conservative, whereas you're a little more intellectually courageous, maybe.
I don't know about that.
This is your show. No?
Right, so.
I'm not the one doing it. No, but yeah. So spatio-temporal. Here we are, kind of in this environment.
Okay. So let's drive it forward a little bit, because I've been sort of holding us back with that sort of irritating Socratic fundamentalism. Well, what do you mean by that? What do you mean by that?
Right.
But because we want to get onto the question of the market.
Sure. So
go ahead and start connecting those.
So how this ramifies for financial markets, and there's a lot to unpack here as well. So specifically, we can digress for a moment, or kind of move over onto a parallel track for a moment to discuss the idea of price and prices in markets. So anyone that's taken a macroeconomics 101 class has gotten an earful about price, probably a neoclassical perspective, and I don't have any reservations about adopting any of that. I think how narrative. I'm more concerned with how narrative acts in the marketplace, and how narrative is used as as kind of a means of framing what we'll call phenomena that occur in financial markets as a way of understanding events that occur in financial markets that would otherwise be incomprehensible to most market participants.
Okay, so can I ask you to give an example to clarify?
Sure. So,
or elucidate might be the more correct word.
Sure. So, without getting too deep into this, and we could get into it further, there's different hypotheses around what makes a market efficient. And what I mean by efficient is markets, free markets anyway, negotiated markets, auction markets, such as what we have with bond and stock markets in the United States and in most of the what we'll call the free world.
I'm really having to bite my tongue here because I think there's always importing all these. I'm like, okay, please go on.
I do this to you. So we'll take just the United States, of course, as an example. And so price is the kind of the recapitulation, basically, or kind of the summarization of all available information about a security, a commodity, a currency pair that is in the marketplace. And when we say marketplace, we simply mean, actors out in, I'm not going to say in a marketplace, but actors that exist, both of whom or severally of whom have an interest in either buying or selling a specific issue, commodity, so oil or Apple or anything you like. So there are a lot of different conceptions of whether or not a market is efficient or is price efficient. It's going to vary from market to market. Some markets are very opaque. You go back to the financial crisis, and you had markets that were built on kind of the last greatest. The last greatest kind of capitalist foray into invention, which would be financial engineering, the pinnacle of our civilization. So you have these incredibly complex products that were created purely, really, out of the profit motive. Anyone that's seen The Big Short by Michael Lewis or something like that, for example, will understand that. So we created these highly complex, opaque financial instruments, and then prices were attributed to them by being marked to market. So there would be an issuer of a bond, for example, was constrained by regulations to adjust the value of the bond that they had created or packaged or issued to the marketplace. It looks like we'll be right back in just a minute.
Right, so we're back, and Andrew is just beginning to unfold his thesis or his tact that narrative is integral to how markets operate in connection with price formation.
Right.
And he was using the example of, he was sort of fleshing out how, say, a bond is priced, and this is a function of numerous variables. But how those variables are integrated in a coherent manner often is the outcome of a story which is told.
Right, so a story emerges, is what we'll say. And a story tends to emerge around prices as an explanation of phenomenon that really can't be explained any other way. So we'll elaborate on that in a moment, but to tie off what I was mentioning about bonds is, so just in summary, different financial instruments or different markets have varying levels of transparency. And a lot's been made of that over the last several years. And a lot of the lack of transparency that exists in markets has been due to financial engineering, and that, at least in part, is created by an intentionally obscurantist motive on behalf of those who are creating those financial instruments.
So it's not a function of oversight or incompetence oftentimes the kind of overwrought mechanisms whereby some of these financial instruments operate are purposefully baroque to obscure what's actually happening.
Right. So certainly again, this is probably the best and certainly the best example in most recent history. But up until that point, financial instruments had been relatively straightforward. Then we saw, some deregulation. I would certainly say in the late 90s going into the early 2000s. And with that, we saw a kind of a concomitant increase in the creativity in financial engineering, such that the price that was attributed to some of these financial instruments was almost arbitrary, or may have been purposefully manipulated to obscure some of what was going on. So, as a great example, there was a time where subprime housing was way down, and it was falling off of a cliff in 2006 and early 2007. And as a result, one would have expected the bonds that held subprime mortgages to fall off concurrently. That wasn't actually the case. And the reason for that, of course, is because the price of those bonds was not determined by an open and free, kind of a democratized market, if you want to call it that. Not even a free market that was being inhibited in some form or fashion, but because those bonds weren't being marked to market, the price of those bonds was basically telling the exact opposite story of what was happening with the subprime market at the time. And so there's a disconnect between price on the one hand and what was actually occurring on the other. Now, there were certain individuals who saw that there was an asymmetrical relationship between what was actually going on in the brick and mortar market, the brick and mortar representation of the market, right, which would be the actual subprime housing market, and the financial instruments that were created as a representation of the activity in that market. And the individuals who saw that, and again, this was described in the book The Big Short by Michael Lewis, just one example of many we could pose. Those who were able to see that early on were able to essentially arbitrage and take advantage of shorting, so that is to say they would profit if those bonds were to decline. So there were a variety of different ways that they could approach that, and there were several different methods that were described in that book, for example. But what it came down to ultimately was that there was a discrepancy between what was really going on underneath and the price that was being attributed to that state of affairs.
So these sorts of situations actually reflect a deficiency in the theoretical characterization of price as an expression of, if not optimal, at least near optimal, as it is expressive of a near optimal state of information availability.
Correct. And so they're
now, I just want to add to that, because a little bit ago you also noted how price is supposedly an expression of all the information which is germane to the commerce in a given product, commodity, issue, what have you. I just wanted to note that implies a selection of information. Even when you say all the information, for it to be actually informative, you have to exclude or weight information proportionally, meaning that this ideal of perfect information is actually predicated upon prior an established set of heuristics or interpretive lenses to approach how you're going to deal with a given commodity, object, issue, what have you. Right? So I think this is an important point to challenge the manner in which people want to lean so heavily on the idea of information as this kind of objectivizing category, because in fact, information already enters into the discourse as a result of subjectively dependent choices in terms of selection criteria and so forth. All that being said,
well, and I should emphasize that what I've been describing, on the one hand, this idea that all we could qualify it by saying all pertinent information,
right?
But even there's some thorny problems.
Constitutes
pertinence, exactly, and that's a significant issue. But economists, and these are of course ideas that have been mulled about and were created by and averred by certain economists, particularly just in the 20th century. So it's a relatively kind of new line of inquiry and a new problematic. But it really did come about with the advent of modern financial markets, and so that would make sense. But what we've been describing is a strong, efficient form of market efficiency.
Right.
So there would be a semi-strong, there's a weak form, and we could go through all of that. But
I'm sorry to cut you off, but just so what you're actually saying then is that what happened in terms of the disconnect between the bond price and like the lead up to the 2007-8 collapse, the bond prices, which were linked to the subprime housing, were asymmetrically related to what was actually happening in the housing market itself, and that this asymmetry actually reflects an inefficiency, and that in terms of information dispersal. Now, that inefficiency, then, one might suggest, was, and essentially we've already done this, itself the outcome of intent. The financial instruments were purposefully designed so as to inhibit the expression of information throughout the market and create a situation which allowed a select few to unfairly profit from that infelicity. And you might say that there is an analogy to what's going on with the idea of insider trading being illegal or immoral. Because insider trading is basically the same idea, right? That you have people who are standing in the way of the perfect dissemination of information, and in this fashion corrupting the operation of the market and price expression.
Some might say that it's a corruption, right?
But others
might say it's irrelevant,
which
isn't to condone the practice, but
well, I mean, it's irrelevant insofar as those people who have access to that information are in a sufficiently diminutive number, we should wrap this up here momentarily, as to make their effective influence on the broader market statistically negligible.
Correct.
Of course, and there's
on
people like George Soros, who would be a powerful counterfactual. He's one actor, but he nearly bankrupted the British government.
Right. So insider traders are or insiders, corporate insiders. They're by definition in possession of what we might consider privileged information, such that they have an asymmetrical advantage in the marketplace, and so anyone that's not in that circle doesn't have that, and so that would be an argument against strong efficiency.
I see. So we'll take another break and come back, and we can move beyond this extended example. So we're back, and we just sort of ran over the question of
Left some tread marks.
Asymmetric information distribution and its implications for market operation. Now, to reconnect with the question of narrative, what you're saying is that narratives emerge to explain twists and turns, which are otherwise, quote-unquote, inexplicable. Now, there's a kind of ambiguity in terms of what you mean by that. You can clear this up. Do you mean by that that narratives are invented to address in a kind of ad hoc manner events which do not fit conveniently within what will be predicted by the dominant theoretical edifice, is that what you mean? But then is not the edifice itself kind of also a narrative, and what is the relationship between those terms? Where does that... In other words, to put it maybe a little bit more concisely, do the stories that emerge, are they just added on after the fact and don't actually have a tight relationship with, let's say, actual causal factors? And in that sense, are they just sort of fundamentally serving to conceal as opposed to illuminate? Or are you wanting to suggest it's sort of both ends with this stuff, right? Because there's that stuff that goes on, but then there's also like what are the actual causal factors?
Sure.
And then thirdly, the narratives themselves are also a causal factor.
Correct.
So all those three things are going on, but maybe you can sort of elaborate or clarify or
sure.
So go on from there as you see fit.
So let's take an example. Apple. Everyone's familiar with the company Apple, of course. Apple stock. It's very popular. I think for many quarters running, it was probably the most by volume, the stock that was held by more hedge funds, and more shares of it were held by hedge funds than any other stock. Retail, which is the little guy, money managers, it's an immensely popular stock. I mean, the popularity of its stock is commensurate with its popularity as a brand. As a result, the market is usually very intently focused on really anything that goes on with Apple. So Carl Icahn, who's a famous activist investor, he's taken to Twitter a number of times and made sometimes veiled references to accumulating more Apple stock, or according to his analysis, Apple stock is worth twice the market value it is today. And then the stock jumps and flips out. The iPhone is released, or Apple comes out with their earnings report, but they haven't sold as many iPhones in China as was expected, and the market responds. Where narrative, so narrative is at work there in the market, but it's never really questioned, because if, for example, more iPhones were sold in the last quarter, and the stock price of Apple jumps, one would say, well, naturally, being the increase in the price of Apple stock, the appreciation of the company, of the value of the company, would follow from news, right, which was formerly, we'll say, epistemically privileged or kind of embargoed. It was the exclusive reserve of the company, and now it's being released to the shareholders and into the public at large. So naturally, that would drive prices up. No one really questions that rational relationship. People would say that the market is responding rationally to the news. It would also suggest that when there's this large disjunction in the price of Apple, we'll say, for example, Apple's at $100 per common share. This great news comes out, or it's news that's perceived as great, and the price of the stock jumps to $110. So we have a 10% increase in the price of Apple stock. And again, no one tends to question that because if good news comes out, or what's largely perceived as good news, then the stock ought to appreciate, right? So there's a kind of prescriptivism there, a rational prescriptivism that says when good things happen for the company, the stock price will follow suit to reflect, right? To catch up rationally. So the stock is said to be pricing in the good news, right?
Right.
The good news, right? The gospel of the iPhone sales.
Evangelium.
Right. So you go from 100 to 110, and that interval is regarded as the kind of the efficiency continuum, such that you go from suddenly it's recognized that there's an inefficiency in the stock price because new information has been introduced such that the market will then auction up or bid up the price of the stock to rational equilibrium. And that is how price efficiency is achieved.
Right.
So, is there a narrative there? Oh, of course. It's the idea that if good news is released, that the stock will appreciate. And no one questions that when it happens. Everyone just shakes their head and says, well, of course, more iPhones were sold than was expected, and so naturally the stock would do X. Where the problem comes in, and where the real narrative structure underlying the market is laid bare, is where good news, ostensibly good news, is released and the stock reacts negatively. Now this is where lots of what I'll call ex post facto narrative attribution will occur, or causal attributions. So the problematic presents itself. Apple releases their earnings report. Inside it, they divulge X number of iPhones were sold. The number happens to be more than the analyst consensus on Wall Street, which people on Wall Street and people on Main Street who are interested, whether they're hobbyists or investing for their 401k or what have you, kind of slavishly follow. And so when that happens and then the price sells off, there's something that I call the scandal of irrationality. And so what emerges is a market sentiment, and I've really just gathered this anecdotally, although I think it's fairly representative looking at message boards and Twitter and what have you. And it's a natural human response that when the stock sells off, there's this kind of this cognitive dissonance, or this cognitive distortion, such that market participants feel that they ought to be able to expect the price of the stock to go up. But when the stock goes down, questions arise. Well, the market didn't respond rationally. There was an irrational response by the market.
Right.
And the question arises as to why there was an irrational response. And this is where narrative begins to take over. And the reason is no one can ultimately say why the market responded irrationally or whether it responded irrationally. We can assume and kind of approximate that the market would respond rationally, and that people, market actors, have a rational expectation of a positive outcome in that scenario that we're talking about. But when the market doesn't respond that way, everyone immediately scrambles asking the question, why? Why did the market do that? And so people immediately begin looking for answers. And again, this is where narrative, kind of the real narrative structure of the market is laid bare, where we have this kind of scandal of irrationality.
Right. So the upshot then is that, well, there's a few different ways of putting it. One is that I think you're suggesting that the story of even approximately perfect information is fundamentally bankrupt for all sorts of reasons. And what's highlighted in your example is that you can have situations here with Apple stock where iPhone sales are in excess of analyst expectation, but despite that, the stock then goes down. And in fact, there are plausible reasons why it might go down, because the price of the stock is not simply the result of one contributing factor, namely iPhone sales. There's all sorts of other things that play into it. But it's actually, and some of them have nothing to do with Apple. You can look at why would someone sell off their stock? It may have nothing to do with Apple's performance as a company. They may be in a curious personal situation where they need to liquidate their assets for cash to address an emergent situation. And in fact, you could have an aggregate of people who, not in a disconnected way, but just by dint of coincidence or a scenario like that, and accidentally you have this sell-off. But it has nothing to do with Apple or Apple's performance. It has something to do with a set of completely exogenous factors. And in fact, these sorts of things happen all the time. It's not like, oh, well, yes, you do have fluke situations. You have to allow for that. But this is, I think, bringing us, and this is what we can pick up on the other side of the break, because we're about to come up on another one. Maybe to the question of, this is where we get philosophical again, in terms of the rationality or irrationality of maybe not just, the market, but even, reality itself, or expectation, and how to deal with all that. So maybe we can pick that up. Or, eventually you may have something else to add to your account.
A little something else to add. So.
All right, so we'll be back momentarily. All right, and we're back, and picking up from the fact that when you look at a disjunction between price behavior and expectations which come about in virtue of standard as opposed to subsequently formulated narrative, you arrive at a scandal to which you were already alluded, and the scandal of, how did you put it?
The scandal of irrationality.
The scandal of irrationality in the rational, or the purportedly rational marketplace. Did you want to maybe unfold that somewhat?
Sure. So there's an expectation when an event occurs that price is going to respond rationally. So there tends to be a kind of a simple causal understanding. If good news is released, then a positive response will follow. Bad news is released, then there will, then things will sell off, as the case may be. But when good news is released and an adverse price reaction follows, questions arise. And as we were talking about during the break, perhaps the one thing that the market or markets cannot tolerate, because markets, after all, are a kind of a social phenomenon that have grown up between people. No matter how many computers and algorithms become involved, at the end of the day, behind all of that are people and their retirement savings, people and their resources. And so markets can tolerate a lot, as they've proven over the years, and have shown remarkable resilience in the face of catastrophes and crises. But they tend to ebb and flow with confidence. And that's because people tend to vote with their pocketbook. And by that I mean, of course, they're either the flow of capital, right, is driven largely by confidence in the future prospects of a security or a commodity or whatever asset class. So when there isn't a rational explanation for an event in the marketplace, a narrative tends to be almost spontaneously deployed in order to make the inferential gap between an event and what's perceived as an irrational consequence, or an irrational kind of repercussion of that release, in order to restore confidence and some semblance of rationality. Now, no matter how far-fetched the narrative may be, as long as a superficially plausible narrative is attributed to that gap, then the idea is that everyone can go to bed happy, or at least with an explanation. Because again, there's nothing that erodes confidence in the market more than the lack of an explanation, or the concession that I don't know. You'll rarely find an asset manager that will tell their client in response to an inquiry about what something happened with such and such stock. You'll rarely see them, or they're loath to say I don't know, because that diminishes their confidence, and that takes away from the perception of them as the professional. And so there's a huge industry. It's called the sell side in the financial services industry that basically just churns out research and recommendations, and is in the business of narrative and causal attribution for why prices behave as they do.
So, sorry for the coughing.
Happens when you talk a lot.
I mean, listening to you talk, I see sort of two lines for further exploration. One being this, that what happens is that you're sort of pointing to narrative formation as having actually less than an explanatory function and more of a kind of preservative function. In other words, it's actually protecting people from an aspect of reality which is apparently intolerable, namely an irrationality in the market. Now, what you could say is, but we could go on about that. The other sort of more interesting, well, I don't know if it's more interesting, but where we might go here is the human need to bring order to a situation, right? On the former point, I would actually suggest that a lot of the narratives serve not only to protect or conceal the reality of indeterminacy and unpredictability, but also to distract from other structural features upon which the market is based that don't wish to be exposed. And here I'm sort of pointing in a Marxist direction to how does class fit into all that, but we're going to just sort of set that to the side now, because that would introduce a lot more than we can bring in here toward the end of the discussion, right? And so just sort of to refocus, how does this relate to the human need for certitude, and is narrative protecting us from a certain aspect of reality as ultimately unknowable? Or how would you go with that? So, to recapitulate the question here, and I had noted that we could sort of take this into a direction of how do other factors like class enter into it, but we're going to set that aside and sort of move in a different line, which receives some allusion at the outset, namely our narratives serving to conceal from us the fundamentally unknowable or scarcely knowable nature of reality, and then you're looking at a question which is bigger than just the markets. It's about how we engage the world itself. So what are your thoughts there?
So I think, looking at markets first, narrative is being used ostensibly as a means of illuminating, and I think that's what triggers it. You'll see media use, of course, news media is all about narrative. One of the functions of media, financial news in particular, is filling in these gaps. And so market participants, whether they're retail or institutional or sophisticated or relative simpletons, will look to news outlets such as CNBC would probably be the prime example. But then even Bloomberg or Fox Business going to be looking at these popular news outlets. Jim Cramer, everybody probably knows who Jim Cramer is, the Booyah guy. While he has, what seems like an encyclopedic knowledge of individual stocks, especially, and by all accounts is the real deal, or was during his time on Wall Street, is now kind of a caricature. But he also, interestingly, and this speaks to the enduring popularity of his show, he serves a vital function in the marketplace, in that there is a marketplace for ideas, and there's a marketplace for guidance that kind of floats on top of and is really a function of the unknowability and the indeterminacy that's inherent in actual financial markets, because people are looking for sages and gurus and prophets and individuals who will confidently tell them, this is why this happened, and here's where things ought to go from here. Oftentimes, such as with Jim Cramer, with virtually no accountability. You never hear, let's bring back so-and-so who was on the call last week and then the stock didn't perform as I expected, and let's talk about why that might have happened. Mm-hmm. You never hear anything like that. So anyway, there is this underlying kind of terrifying unknowability in markets and in many other facets of life. Everything from, what happens, if anything, after death to, we're this small little speck of stardust in a seemingly infinite universe, and just conceptualizing of how small and insignificant we really are, if you ruminate on that, can be terrifying. And so that kind of, there's import in all sorts of different directions, which is difficult to really contemplate. It's easy to kind of bandy about, but, in those, quiet moments alone, where you're face to face with these ideas, some of them can be really difficult to contemplate. So one interesting thing that does happen in markets, though, is so narrative plays a vital role, not only in coping, but as you say, in protecting us from kind of the terrifying realization of the unknowability of something that's near and dear to a lot of people. So as we were saying, we're talking about people's retirement savings, their ability to subsist in retirement, their college savings for their children, things that are just kind of inextricably bound up with family and matters of the heart and their future prosperity, or their ability to just live and function. And so not knowing, or having a big question mark, or not having any kind of just a guesstimate of the probability of certain outcomes, while true, is really too terrifying to contemplate. And so narrative is often deployed as a mechanism to kind of, maybe not obscure that, but just kind of
put it at a distance,
sweep across it. But what ends up happening in markets and in people's lives ultimately as a result of this is that because narratives are more concentrated on and concerned with plausibility and the appearance of plausibility than actually incorporating, objectively verified information, you end up, or what ends up happening is that is disinformation is inadvertently introduced into the system of the market, and the result is that further information asymmetry and that different disinformation creates additional what we'll call opportunities for nascent crises and disjunctions between price and and earnings or what have you to come about. And so so this mechanism that we're using to kind of preserve and protect and cope ends up creating and sowing the seeds for and setting the stage for additional heartache and difficulties down the road. And that is, in one respect, the boom bust cycle kind of encapsulated in a cycle of confidence and deteriorating confidence, etc. So, and that is the thesis in 1 hour.
Well, yeah. I mean, I think the last point can be generalized, that the effort to avoid confronting that unknowing actually exacerbates the situation, because it's inescapable. The mysterious is inescapable, and the more one tries to avoid that encounter, the worse you're actually going to make it for yourself. Now, this actually, and now we're at the end, but this is something to take up, I think, is a crucial issue for modernity and the scientific project, and how it informs how we orient not just the economy, but our politics and all the rest of it. Because that was the great Cartesian hope, that we could achieve an absolute clarity and certitude. But does that aspiration perhaps actually put us at odds with reality itself? So I think, I guess we'll end there. We'll end with that question. It's a big one. So, but we'll come back for more, it is hoped, in the near future. Of course, we can't know with absolute certitude. So, but anyway.
Well,
thank you,
thanks
Andrew.
for having me on, Tom.
Right on.
To do it again.
Woo! So, and thanks to Rob Myers, he's back there behind the camera, and Amy, I know she's been our spectator, our token, and Justin Dunn, and yeah, we're shooting from Red Tree here in Cincinnati, Ohio. So, thank you, Justin and Red Tree, and everybody else. So, have a good day.